Hi, and welcome to Chapter 7, Using Consumer Loans. Learning objectives of this chapter include know when to use consumer loans and be able to differentiate between the major types, identify the various sources of consumer loans, choose the best loans by comparing finance charges, maturity, collateral, and other loan terms, describe the features of and calculate the finance charges on single payment loans, evaluate the benefits of an installment loan, and determine the costs of installment loans and analyze whether it is better to pay cash or take out a loan. How will it affect me? It is important to understand when to use each credit source to be able to calculate and compare their costs and determine the circumstance in which it is best to take out a loan or pay cash. Consumer loans, the ability to borrow does not mean that you need to borrow funds. Purchases should only be made when you have budgeted for the purchase. Items purchased should have a useful life longer than the term of the loan, which we already said prior to that. Should you borrow to pay for a wedding? Should you borrow to pay for an education? Okay. Loans made for specific purposes using formally negotiated contracts that specify the borrowing terms and repayment. One-shot transactions made for specific purpose. Unlike a credit card, no more credit is available. The amount of the loan is fixed, specific to one transaction. No credit cards or checks. Used to borrow money to pay for big ticket items. That's the consumer loans. That's what they are. Okay. Types of consumer loans. Auto loans, durable good loans such as furniture, appliances, things like that. Education loans, personal loans, consolidation loans. Federally sponsored student loans cheaper than commercial loans. That's not true for the most part, depending on your interest rate. Many student loans are 6% interest rates right now, and you can get a consumer loan for 4.5%. And there's far fewer fees for consumer loans than student loans. Type of federal student loans. Students, see right there, 5%, 6.6%. It's extremely expensive. The parent loan is 7.6%, and these cannot be written off in bankruptcy. They are excluded from bankruptcy. Where the other loans, if this pandemic that happened, and if you lost your job and didn't get it back and you couldn't pay the loans, you could declare bankruptcy. Wouldn't even touch student loans. Consumer loans, single payment, made for a specific period of time, installment, repaid in a series of fixed scheduled payments rather than a lump sum. Fixed interest rates, variable interest rates, depends on the loan as to which one it is. Source of consumer loans, commercial banks, consumer finance companies, which have the highest rates. I used to be a branch manager for Beneficial Consumer Discount Company, and our loans would go as high as, well, it depends on which state you're in. I was in Pennsylvania and New York, and our loans went up to 30%. Some states they went even higher than that. Credit union, savings and loan association, sales finance companies, life insurance companies, and friends and relatives like State Farm, they'll do loans as well. Credit unions. This is why it's a good reason. This is why it is good to belong to one or two credit unions. So if you have a chance, you should join a credit union. There's at least 3 here in Ada that you could join any one of them. and start a savings account and just put so much money in each month uh, as a savings account, put it in and don't ever take it out, so that they can show that you're saving money. And they are usually the most lenient when it comes to giving loans. Features of commercial loans: finance charges, loan maturity, total cost of transaction, collateral, others, payment date, prepayment penalties, excuse me, and late fees. Okay, so keep track of your credits. See worksheet 7.1, which is in your book. Um, Keep an inventory sheet of your debt. No total monthly payments. Total debt outstanding. Check your debt safety ratio. Should be less than 20. Debt safety ratio equals the total monthly payments divided by your total take-home pay times 100. So if your total monthly payments are $1,000 and your total monthly take-home is $2,000, so 1,000 divided by 2,000 would be 0.5, or 1/2 times 100, so that would be a 50. So that's far more than 20, right? So if your total take-home is $2,000, then the most your payment should be is 400. Okay, um, which most car loans today are over 500. So it'd be very difficult to live on $2,000 a month. Single payment loans, loan collateral, for example, your car, chattel mortgage, borrower retains possession of property, collateral note, lender retains possession of property. Okay, so this would be like a pawn shop or something like that, where they retain possession until you pay them back. Okay. Finance charges, simple interest method, calculate outstanding balance, which interest like PRT. Discount method, interest calculated on beginning principal balance and is subtracted from loan amount. The remainder goes to borrower, pays off. Okay, so I equals PR, simple interest, I equals interest or finance, P is principal, loan, balance, R is rate, T is time, so I equals PRT, principal times rate times time. Loan, $10,000 for 2 years at 8%, interest for entire term of the loan, no compounding, so we're keeping it simple. So 10,000 times 8% times 2 years equals $1,600. So that's how much your interest is, and then you add that on to the principal, and that's how much you pay off, $11,600. That's very simplistic. It doesn't work like that because all loans are compounded, but that's just to give you a rough idea of what that is like. Okay, so average annual finance charge divided by average loan balance outstanding is your APR. So in the same example, 10,000, 8%, 2 years, it's 8% times 10,000 times 2, so that's 1,600, divided by 2 is 800, divided by 10,000, okay, equals 8%. Okay, so here's your discount method. Again, you're talking about the same formulas, only this is a little bit different, so your APR is actually 9.5%. APR usually has the fees in there as well. Installment loans, you repay the debt in a series of equal payments. Payments include principal and interest. Wide maturity ranges from 6 months to 10 years, or if you're talking about a mortgage, that's 30 years. Although now they're having mortgages that are much larger. I've heard of a 60-year mortgage in some areas of the country. Calculating finance charges. Interest is calculated on outstanding balance. Could be calculated on any given term, daily, weekly, monthly, quarterly, annually, semi-annually. And there's an example. Okay. And again, we're doing a simple interest method. 452 times $452.27 times 24 months equals $10,854.48. The loan amount was $10,000, so the difference is your interest. Okay, add-on method, 10,000 times 8% times 2 years, 1,600. That's 11,600 divided by the number of payments, so that's $483.33 for 24 months. Okay, all these are just different examples of how you calculate them. Okay, most easiest way is just to get on the computer and get financial calculator and put the numbers in, and it'll work its way out. Okay, other loan considerations, prepayment penalties, credit life insurance, rule of 78 is the sum of the digits. A method of calculating interest that has extra heavy interest charges in the early months of the loan. Most loans, the majority of the interest is in the beginning because that's when the principal is the highest. And then as the principal gets lower, the interest rate gets lower. The interest gets lower as far as the dollar amounts go. And so if you have a loan that was a 8-year loan or a 5-year loan, and you're down to the last 6 months, you're paying almost 100% principal. Almost. A little bit interest, but it's almost 100% principal. So there's really no point in paying it off if you're less than a year, because the amount of, unless it's a very, very high interest rate, but for a single digit interest rate for a loan that's 5 years or longer, the last 6 months is almost no interest. Okay. Buy on time or pay cash. There's a worksheet in your book, 7.2. Cost of borrowing is total of payments, less principal of loan, cost of interest, cost of using cash, opportunity costs of lost interest, tax after tax rate. Okay, so many times what you can, here's the decision rule, cost of borrowing greater than the cost of using cash. So if difference is small, may decide to borrow and maintain a high level of liquidity. So one of the things you can look at is inflation coming back? If inflation's coming back, it's much better to borrow the money because the dollar is going to decrease in value, so the loan will get cheaper because of the cheaper dollar over time. If inflation's not coming back, then it's cheaper to pay cash because the dollar is going to stay constant and you're not going to gain anything. Now, there's many other things to consider. Can you use the cash for something else to make more money? Can you use the interest on the loan as a tax deduction? Is it an expense? If you're buying a rental property, then the interest is an expense, so you can deduct it off your taxes. It's reducing your income from the rental property. Okay, so it all depends on what you're doing. The main thing to know about this, and if you ever read the book Rich Dad Poor Dad, which I highly recommend, it's by Robert Kiyosaki, he's the author. You borrow money and you buy things that are going to make you money. Okay, rental properties make you money. A new car, unless you're going to be an Uber driver or a Lyft driver or something like that, does not make you money. It depreciates, which means it costs you money. So jewelry does not make you money unless you have to have a certain facade, a certain image to then secure a deal to make money. Jewelry does not make you money. And now watches, if it's a fine watch, it's a collectible, that could make you money. But you don't wear it, you store it so that it doesn't get damaged. So in the long run, you have to look at, is this going to make you money or lose your money? If it's going to lose your money, you better pay cash, because if you borrow the money and it loses you money, then you're losing on two different ends as opposed to just one. Okay? But there are many things to consider when you're looking at borrowing or paying cash, and to see what you're actually purchasing, if it's worth it or not. Okay, and that's the end of the chapter.